Hey everyone, welcome back to Corporate Decoder. Get ready because we're about to dive into a financial report that tries to make bond funds sound exciting. And believe me, there is more going on here than meets the eye. Today we're dissecting a filing from Columbia Fund's Series Trust, specifically looking at their Columbia Income Builder Fund. This isn't just a dry financial document, folks. It is a peek behind the curtain at how this fund operates, how it is managed, and where your potential investment money could be going. We'll break down the key financial numbers, explore the fund's holdings, and understand the costs involved. Before we start, if you appreciate getting straight insights from corporate documents like this one, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more filings and discuss investing strategies. Alright, let us get into it. We're re-looking at a semi-annual shareholder report for the period ending the 31st of July, 2025. Think of this as a mid-year check up for the fund. First up, let's talk about costs. For a hypothetical $10,000 investment, the cost can really add up depending on the share class. For Class A shares, the cost for this reporting period was just $19, representing 0.38% annualized. Now, that sounds small, but for the Class C shares, that same hypothetical $10,000 investment cost a hefty $57, which shakes out to 1.13% annualized. And for the institutional class, it was a mere $7, or 0.13% annualized. This is a crucial point. These seemingly small percentages can make a big difference in your long-term returns. As of the 31st of July 2025, the fund net assets were a substantial $839,778,006. That is a lot of money being managed. Now, the heart of any fund S report is its investments. Here we see a breakdown of where the money is actually put. As of the 31st of July 2025, the fund had significant holdings in equity funds, making up 26.5% of its assets. Within equity funds, we see investments in places like the Columbia Convertible Securities Fund, Institutional 3 Class valued at nearly $20 million, and several dividend-focused funds like the Columbia Dividend Income Fund and Columbia Dividend Opportunity Fund, each holding tens of millions of dollars. But the real story here is the fixed income side. A whopping 63.2% of the fund, S assets are in fixed income funds. This means the fund is heavily weighted towards bonds and other debt instruments, aiming for income generation with generally lower risk compared to pure equities. Within fixed income, the largest single holding is the Columbia Quality Income Fund, Institutional 3 Class, sitting at a massive 28.4% of the fund S net assets. This is followed by the Columbia High Yield Bond Fund, Institutional 3 Class, at 9.2%, and the Columbia Floating Rate Fund, Institutional 3 Class, at 7.2%. The fund is also investing in emerging markets bonds and mortgage opportunities. They also have a slice in the Columbia Short Duration Bond ETF at 4.9%. This tells us a lot about the Fund S strategy. It is clearly trying to balance income generation with a degree of stability by investing in a variety of fixed income instruments. The fact that many of these holdings are also affiliated funds managed by Columbia Management Investment Advisors, LLC, is also noteworthy. This is what they call a fund of funds approach. And speaking of affiliated issuers, the filing details significant transactions with them. For example, the fund saw net changes in unrealized appreciation and depreciation amounting to many millions of dollars across these affiliated holdings. The goal of these affiliated investments is often to create a smoother, more predictable income stream for the investors. Now, let's look at how the fund has performed on a per-share basis for different classes for the 6 months ended the 31st of July 2025. For Class A shares, the net asset value started at $11.69 and ended at $11.92, showing a modest gain. Class C shares saw their net asset value move from $11.75 to $11.98. Institutional class shares grew from $11.7 to $11.92. These gains, while not explosive, are positive and indicate a steady performance. The total return for Class A shares for this period was 3.94%, for Class C it was 3.54%, and for institutional class it was 3.98%. This means that after accounting for reinvested dividends and distributions, an investment would have grown by these percentages. Keep in mind these returns do not reflect sales charges. When we look at the expense ratios of the different classes, it is clear why choosing the right share class matters. For Class A, the gross expense ratio was 0.38%. However, for Class C, it was a much higher 1.13%. For institutional class shares, it drops to just 0.13%. This reinforces the idea that institutional investors often get better pricing. By the end of the period, the net assets for Class A were $573,158,000, for Class C $65,633,000, and for institutional class a hefty $165,114,000. These numbers show the varying amounts invested across the different share classes. Digging into the notes, we find important details. For instance, under fees and other transactions with affiliates, we learn that the management services fee for the investment manager, Columbia Management Investment Advisors, LLC, is a flat 0.02% of the Fund S daily net assets. This is quite low, which is partly offset by the fees paid to the underlying invested funds. The report also touches on expense waivers and reimbursements. Columbia Management and its affiliates have agreed to cap operating expenses for various share classes. For example, for Class A shares, they have committed to keeping expenses below 0.51% through May 2026. This certainly helps investors by limiting the drag on returns. Looking further, the filing provides tax information. At the 31st of July 2025, the Fund S federal tax cost of investments was approximately $837,897,000, with a net unrealized appreciation of about $2,102,000. This means the value of their holdings was slightly higher than what they paid for them on a tax basis. A section on legal proceedings notes that Ameriprise Financial, the parent company, is involved in usual business litigation. While they believe nothing is likely to materially harm the fund, they caution that adverse outcomes could lead to increased redemptions or damaged reputation. This is a standard disclaimer, but it's always wise to be aware of these potential headwinds. In conclusion, this report paints a picture of a fund that is heavily invested in fixed income, aiming for steady income generation. The performance appears stable, with modest gains across its share classes. The difference in expense ratios between share classes is significant, highlighting the importance of understanding those details when investing. The fund strategy of investing in affiliated funds means it benefits from economies of scale within Columbia's own product family, but also means the overall performance is tied to the success of those underlying funds. The management fees are quite low and expense caps are in place, which is a positive for investors. However, like any investment, it is not without risks, especially related to market conditions and potential legal issues at the parent company level. Alright, that is our breakdown of Columbia Funds Series Trust I's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think a fund of funds approach like this is smart strategy? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and be sure to subscribe for more deep dives into these financial reports. And as always, don't forget to check out our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.